Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and the mechanics behind a potential short squeeze. Today, we're taking a unique look at a specific company that has landed on our hard-to-borrow screener, TGHL. We'll break down what makes TGHL stand out, what a staggering cost-to-borrow fee truly means, and what you need to know about the potential for a squeeze. But before we get into the details, the quick but crucial disclaimer. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about TGHL. This is a microcap stock, and interestingly, its sector information isn't readily available, which is not uncommon for microcaps. Now, for the hard numbers. If we look at recent price action for TGHL, it's been quiet. Today's change is exactly 0.0%. Over the last 5 days, TGHL has also seen a 0.0% change, and looking back over the last 30 days, it's the same story, 0.0% change. Volume data paint a similar picture right now. Today's volume is 0 shares, the 30-day average volume is 0 shares, giving us a relative volume of 0x average. So, on the surface, TGHL looks dormant. But there's a crucial hidden dynamic at play, and that's why we're talking about it today. What's cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? When short sellers want to bet against a stock, they don't own the shares. They have to borrow them from someone else, typically a broker. For that privilege, they pay a fee, much like paying interest on a loan. This is the cost to borrow. It's usually expressed as an annualized percentage. When this fee is high, it signals that there's intense demand from short sellers to borrow those shares, but the supply of available shares is very limited. This scarcity drives up the price for borrowing, sometimes to truly staggering levels that can exceed 100% annualized, meaning a short seller could pay more than the stock's value in a year just to hold their position. Why this stock is hard to borrow right now. Now let's apply that to TGHL. Our screener flagged TGHL because its cost to borrow fee is an astonishing 773.1% annualized. Let that sink in. Almost 800% per year. This is an incredibly high number and indicates extreme demand to short TGHL coupled with an extremely tight supply of shares available to borrow. While the exact number of shares currently available to borrow for TGHL is unknown, this sky-high fee tells us that finding those shares is very difficult and expensive. With an estimated float of 12.7 million shares, if a significant portion of those are already shorted or held tightly by long-term investors, the pool for new short positions can quickly dry up, forcing CTB rates through the roof. Squeeze mechanics explained. So, what does a high CTB mean for a potential short squeeze? Imagine short sellers have borrowed shares of TGHL and sold them, betting the price will fall. But if the price starts to move up instead, they face a few problems. First, they're losing money on their short position. Second, their borrowing costs, which for TGHL are already 773.1%, continue to accrue daily. Third, if the supply of borrowable shares tightens further, they might receive margin calls from their brokers demanding more capital to cover their losing positions. Faced with maintained losses, increasing fees, and margin calls, short sellers are often forced to buy back the shares they initially sold to close their positions and cut their losses. This sudden, forced buying creates upward pressure on the stock price, which can trigger more short sellers to cover, creating a cascading effect known as a short squeeze. Dilution risk check. Before getting too excited about squeeze potential, it's critical to check for dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. Even with a high cost to borrow, a company issuing a significant amount of new shares can flood the market, providing short sellers with new shares to borrow or cover with, thereby negating the scarcity that drives the squeeze. For TGHL, our check found no recent dilutive SEC filings, specifically SMINUS1, SMINUS3, or 424B forms, in the last 90 days. This is a positive sign for any potential squeeze thesis, as it suggests the company hasn't recently added to the share float, which could otherwise undermine the hard-to-borrow situation. Again, a very important reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, with TGHL's unique situation of extreme CTB but currently no price or volume action, what should an educated trader watch for? A high cost to borrow, while a strong indicator of demand to short and limited supply, does not guarantee a squeeze. It could also mean short sellers have extremely strong conviction in their bearish thesis and are willing to pay a premium to stay short. For TGHL specifically, given its current dormancy, you'd want to look for any return of volume, even small amounts, and accompanying price momentum. If volume returns and the price starts to climb, that's when the squeeze mechanics could potentially kick in. Keep an eye on any updates regarding borrower availability. Shrinking supply is key. Our internal composite squeeze score for TGHL currently stands at 46.5 out of 100, which reflects its high CTB but also considers a lack of momentum and unknown borrower supply. It suggests potential, but not an active squeeze setup. To recap, TGHL presents a fascinating case study in hard-to-borrow stocks, boasting an exceptionally high cost-to-borrow fee of 773.1% annualized, with an estimated float of 12.7 million shares. While currently inactive in terms of price and volume, this extreme borrowing cost signals a severe scarcity of shares for short sellers. We've explained how this can theoretically contribute to a short squeeze should market dynamics change and buying pressure return. The absence of recent dilution risk is a positive, but remember, a high CTB doesn't guarantee anything. It's crucial to understand these underlying mechanics. If you found this breakdown of TGHL and short squeeze dynamics helpful, please give this video a like, subscribe to the channel for more educational content, and let us know in the comments below if there are other stocks or topics you'd like us to cover. Thanks for watching, and happy learning!